Hey everybody, Preston Bryn here. Welcome to our free edition of our weekly Trader User Group Weekly Roundup. This is for the trading week ending June 12th, 2020. The week's theme, as you can see, is Attack of the Zombies. And of course, our trading motto is don't be a rat brain trader, be the red striped zebra. We want to be the contrarian in the group. If the minute you start trading like everybody else, then your performance is going to underperform. Um, and that's just something that I think most traders that have been doing this for a long time understand. So let's just take a look at where we are with everything. I know everybody's wondering with this pullback here, is this a time to buy? Will it go a little bit deeper? And if you missed out on the run that we've had over the past 8 weeks, you're probably more inclined to jump in for fear of missing it again. But let me just go through a couple of things on index performance, go through some of the weekly sound bites for the markets, and we'll go take a look at the charts here. And I'll just give you my take and tell you what the charts are actually showing right now. Okay, so having said that, let's just take a look at the sector performance here. So if we look at the U.S. performance, we can see the Dow is down a little over 5.5%. Year to date, it's down over 10. S&P down this week again 4.7, 4.8%, down about 5.8 for the year. Nasdaq had the best week, although it was still down 2.3. Year to date, it's up 6.87. And the Russell is down just slightly under 8%. Year to date is having a whopping 16.8% down move. Okay, so not that good. And of course, if we look at the sector performance, everything good and bad was in the red for the week, but you can see the best performing sector was technology. It was only down 2.76%, as evidenced by the best index, which was NASDAQ. The worst performing sector was energy. It was down a whopping 13.4% for the week. Okay. And of course, if we look around the world and see what else is happening, as I said, in Europe, the FTSE was down a little over 5.8. The CAC 40, which is the Paris index. For France, it was down 6.9, and the DAX in Germany was down 6.99%. And then on the Asian markets, not as bad as Europe and the US, but still all in the red. 2.44% for the Nikkei. China was down about 38 basis points in the Hang Seng. The Hong Kong index was down 1.89%. So you can see there this past week, it was not a pretty week, folks. And then, of course, if we look at U.S. valuations, you're going to see here the trailing 12-month PE ratio came in at 26.28, and the forward PE ratio for U.S. Is 24.15. So it's lower by a little over 8% from the trailing 12-month, but that's still relatively high. But as we've said, and I said, with very low interest rates that we have, then it tends to create a little bit more of an asset bubble and increases and inflates the PE ratio. So that's normal. The dividend yield for the S&P is at 2%, 10-year treasuries at 69 basis points. So the spread between the two is 1.31%. So big money is going to continue to go into the S&P because it's like carving a little drainage ditch. The water's going to flow downhill. And that's kind of what we're seeing there from that perspective. Now, if we take a look at some of the weekly sound bites, let's just go see what's going on around here, and then we'll jump into the charts. So this past week, as I said, and as you saw, stocks have suffered their worst weekly decline in almost 3 months, right? And that's after climbing about 40% off the March 23rd lows. You know, I think we're seeing and some investors taking some profits off the table. Also, a little bit of a response to a worsening of the pandemic in some parts of this country. And we're seeing some of the value sectors like energy and financials fared the worst, and some of the faster growing sectors this past week that held up the best were those that were reflecting renewed interest in stay-at-home stocks like Amazon, Netflix, stay-at-home things like that, right? We're also seeing a rise in liquidity. And hence the weekly motto of the zombie companies, because with a rising, you know, you've heard the saying, rising tide lifts all boats. Well, that's true. More liquidity lifts many ships in the harbor, including, or all ships in the harbor, including a lot of the rust buckets that shouldn't even be in the harbor. So we're seeing, and most financial analysts define a rust bucket company is where their debt service exceeds their profits. So they shouldn't be allowed to survive, but they do when you put a lot of liquidity out there. And we've seen in Barron's, I think this weekend they had talked about over 18% increase in some of these rust bucket companies. So it just, there's going to be a longer term cost to keeping those things alive. But that's what excess liquidity does, guys. It just does that. Now, this past week we had the Fed meeting, and in his post meeting press conference on Wednesday, Jerome Power Ranger Boom Boom Powell kind of surprised investors with a little bit of a bleak assessment on the pace of the recovery in the coming months. He predicted unemployment is going to end 2020 at 9.3%, kind of warning of permanent job losses due to the pandemic, right? So, you can try and pin the tail on the donkey for why the markets fell so hard on Thursday, but you really can't just pick one thing. I think that the markets were ready to peel back and they were just looking for an excuse. But you could say some of that bleak assessment by Powell, some of the rise in COVID cases as companies or states start to open back up again. But it was really the largest decline in the S&P anyway since March 16th. As this, kind of a growing fear of a resurgence of some of these infections kind of made their way back into the national mindset. Okay. Now, also, there is a risk-off response to these renewed pandemic fears. As I said, it sent the yield on the 10-year benchmark note really lower, down to, as I said, 69 basis points. Credit spreads in the investment grade corporate bond world also widened. That's as most investors demanded a little bit more yield to compensate for the extra risk. But the Feds are going to watch that very closely. As you guys know, they're putting a lot of money into the corporate bond market, even the munis, the municipals. They're doing that to the extent of also buying ETFs. So these are just first unheard of types of things the Feds are doing, and that's helped reduce the spread between investment grade and junk and muni bonds, right? So that's helped out dramatically. The other thing that I found of note this past week is the Organization for Economic Cooperation and Development. I think it's a kind of a funny name, but anyway, they came out and said that the coronavirus had contributed to the worst economic crisis since World War II. So that obviously didn't help on the news as well with Boom Boom Powell's statement during his press conference. In fact, the organization expects global GDP to contract about 6% in 2020 versus a year ago, right? On the assumption that the pandemic will continue to recede and remain under control. Now, if we have another second wave that's very ugly, and it really outbreaks very strong, it's going to get real ugly and we're going to see a bigger drop. But most people aren't expecting that. And in over 150 years of data, there's never been a recession that spanned the globe to the extent of the one that we're seeing now in 2020. The World Bank had estimated that nearly 93% of the world's economies are going to see an outright drop in their GDP this year. Just to give you a reference point, in 08 and 09, I think it was like around 70, in the low 70% area, 75%, something like that. But now we're going to get 93%, so just about every country. But I don't know why that should surprise people, because when you turn the lights off, things get dark. And that's what's happening with the economy. Some people are saying this like, wow, look at what's happened here. It's the worst since the Depression, or even worse. But yeah, no shit, Sherlock. You turn everything off, force people at home. That's what happens, which is why they don't want to stay closed. That's why I also believe the second wave, I don't think people are going to shut back down again. They're just going to change the rules of the game just a little bit. Okay. But they're going to stay open. It'd be a huge mistake to close back down again. And then across Europe, those European markets, as I said, they're all down 5, 6, 7%, are reflecting the same thing. And we're seeing an economic data hit the tapes this past week, like the GDP in the UK shrank by a record 20.4% in April, right, from March. That's huge. And in Germany, we got a lot of data around their industrial output. Remember, Germany lives and breathes on their exports. Right, and that dropped, and their trade data dropped much worse than expected. So the shaking a little bit of the confidence across Europe as well. And then on top of all this, just kind of simmering in the background is the U.S. trade efforts with China, and just a lot of the tensions that's going on there. And on top of it, you throw the COVID-19. So that's really kind of just blown everything up just a little bit. So the fact that a lot of traders missed out on this 6-week, 8-week run that we've had off the March 23rd lows, then you're going to see, I think, buyers willing to step in because they're going to have the mood or the sentiment that says, I'm not going to miss another run higher. But I think it's a little bit too early right now to jump in. What I'm going to do is I'm going to freeze the screen. Let me just stop showing it for a second. And then I'm just going to switch over to a couple of charts, and I want to show you my reasoning why. Okay. So let me just move a few things around here on my screen here. So just bear with me 1 minute. And then I'm going to bring up a chart of the E-mini S&P 500 futures. Now let me just bring this up here. Let's just get it on the screen for you guys. All right, so bear with me as this thing comes up. And what it's going to be is a daily chart of the E-mini S&P 500 futures. And I've got Fibonacci nodes printed on there, as well as the yellow line, which is the 200 SMA, not the EMA, and the 50, or the red line, which is the 50 SMA, not the EMA. Okay, simple moving average. And as you can see on here in this daily chart, and as I've said, each week for, I guess, since we've blown through the 61 percentile reading here, just a couple of key points that I think are very important. Going back since 1950, when we've climbed up above this level right here, essentially, we've never come back down and made new lows when we've been in a bear market. So I've marked the pivot high and the pivot low down here, and then these are just fib extensions off the lows. Okay, so we've taken out the 618, which is at 29.30, and then we just moved right up and we took out the 786, which suggests that, yeah, we're going to make new highs, but not without some kind of dip or some kind of pullback in action. And you can see this pullback here over these 3 days. You can see Friday, a little bit of a misdirection, but I'm going to take it out to a weekly and show you why it's more bearish than bullish. You can see we did recapture the 200 SMA here. We were actually well below it, and then we closed up strong in the E-mini futures. We closed up 25 points on Friday. Okay, so we were able to hold the 200 SMA, as you can see here. These zones right here represent pullback points, which is where I believe we can come to, right? So I am not going to want to look at buying anything at this point in time. Remember, for our members, we were going long back over here, and I was suggesting we need to pick up some longs off these pivot lows that were made back here like this. And then each step of the way, we've been leaning to the long side, okay? And it's just worked out very well for us. So this is definitely a profit-taking mode. The minute we got above this, I said we're going to pull back anywhere from 100 to 250 points. But if you look at this zone here, I'm calling this our S1 support zone right here, okay? And you can see here from 2930 down to roughly 2800 is where I think we can go to. Now, it would take us below the 50 EMA right here. This is a near-term pullback point, and this is a further term pullback point. These are generated by my software, but I could also generate them by just manually drawing them. These are fib nodes and Gann extension lines, which incorporates not only price, but also time. So a lot of traders only consider price when you trade, but you also got to consider time as well as an element in the trading. But you can see here, this is where we're sitting right now. Now, if I were to just kind of clean up my screen just a little bit and come in here and show, a little bit of a near term, this near term is going to be sitting right here at 29.30. Okay. And obviously our R1, our first level of resistance to the upside, is going to be coming back up and taking that out right there. Okay. That would be our R1. This would be our S1 right here. Now I had an S1 zone that's fairly wide, right, which is going to represent a consolidation point. And we could get down there, and then that's going to scare the children. And a lot of people are going to get out. And then when we start back up again, I think you're going to see bigger money come back in. Some of the retail rat brain traders have been jumping in and chasing this area here, and they've probably given up everything that they made coming in late right in this area right here. As soon as it took out the 200 EMA, they get long right here, and then they get out right here, and it's a net zero, right? Meanwhile, they watch the market move up like this, and they just lost out on everything, right? I mean, They're like, okay, I'm not taking that trade right there, and they missed it. And then they jump in right here, and then it comes back here. They jumped in and they're, patting themselves on the back here, and then it comes back again, and then they missed it again. So retail rat brain traders, in our membership, that's why you want to be the red striped zebra. We just do not want to follow what a typical retail trader is going to do because they're going to mess it up. Okay. So this is where we're looking right here for our members this Sunday evening. I'll go through a little bit more detail on this. Now, the other thing that I want to show you, let's take this out to a weekly chart, and I'll show you here a really interesting pattern. If we come out on the weekly, and let me just widen it out a little bit here for you. So if you look at this, this shows the pullback points, of course. But if we look at this weekly chart, do you guys see what I see? Let me just point it out if you don't. This is a candle when we had a really strong week, and this was the prior week. Notice we made a high here, which took out that high here. Notice we made a low here, which took out the low there. And notice the low closing low here and the opening high here also took out the prior candle. That's what's called a bearish engulfing candle. So on a weekly chart, when you have a bearish engulfing candle where the highs and the lows take out the previous candle, then that is a bearish signal. All right. And that would suggest more downside. So what you don't want to do is get sucked into this move where, okay, yeah, we finished the week off the lows, okay, and we actually came all the way down here, and then we closed up here, but you just don't want to look at it that way, okay. And let me just get this off the screen here and get back to my drawing tool. Let's take it back to the daily chart. You don't want to do that. And this move right here for the day, let's just take it intraday here. Let's just come into a 30-minute chart. You can see on this 30-minute chart as I just kind of edge it out a little bit, right, like this. Okay, on this 30-minute chart here, unless or until we come in here and take out that high right there, right? Notice we took out the previous pivot low, right? So we came down here and then we closed right in this area here. Unless we take this guy out right here, then I would remain bearish, all right? Or play it to the downside. Because if we break this level right here, which was this prior pivot low right here, then the odds favor us breaking this pivot low and then coming down and testing that 61.8% fib extension node right there. Okay, doesn't get any simpler than that, guys. So you want to be very careful in these markets, because in these crazy markets like this, the markets are going to want to suck a lot of people in, and it's always the rat brain trader that gets sucked in. And of course, us red striped zebras, we're going to just sit here and watch it. And doesn't mean you're going to be 100% correct. But it does mean that you're generally going to manage your risk, and you're going to be on the right side of the trade. Okay. And of course, if I show you the Ichimoku on a tighter time frame right here, you can see here on this 240-minute chart, we blew right through the green. So that's going to be our resistance point. And you can see these were our former R1 and S1 zones. Now this is an S1 zone from 29.65 to about 29.50. And then we got a further S2 zone down here like that. Okay. So we got to be very careful, guys. Now, I'm going to switch my screen just 1 second, so bear with me. Let's just move this around here like this. Just move it around. So let's wait for a second for the screen to come up, guys. So now, right here, I now have it switched over where I'm showing EMAs, not SMAs, for the 50 and the 200, right? But notice here on this chart, and this is a weekly chart. Let's put it back on the daily again. Notice here on this daily chart of the E-mini, same chart, we came right up to the 2019 close. We actually had a couple of points up, but it was almost flat. The SPX, the cash index, actually moved into the green a little bit and then rolled back over. But the E-minis, the futures, came right up, hit the opening, and then came right back down again. Notice here on the EMAs, we're getting a cross in the 15 to 200. That's a solid bullish sign. Again, if you throw in there the combination of extending above the 61.8 fib nodes, you throw in the 5200 cross back up, we're not going to make new lows. I think we're just in this dip correction moment. And by the way, the markets are, it's very healthy to see a correction here. And I think we got a little bit more downside to go, and then it's going to correct, and then it's going to move back up. So for members, we'll go into more detail on some stocks I like. I pointed some out last Sunday, and we'll take a look at where you want to be playing this thing and some of the best ways to play. Okay. So that's a little bit about what we're seeing here on this market. And then, of course, if we come over and look at volatility, you can see here, as usual, the volatility, I've got the zones highlighted here. The black is the black swan zone. Look at the big movement in vol. And if I just put it on a weekly, just to give you a weekly view, you can see that big green candle. I mean, we went right back up there like I indicated we're going to do. Vol is very sensitive. Once it moves up this high, it's very sensitive. Now, you can see here the 96.40 was the high point for volatility, the VIX, in October 2008, but it never closed there. It closed in the 80s. Actually, it closed below the 80s. It closed in the high 70s. We actually had a couple of days of closes over the 80s here in this COVID crisis here. But you can see how vol moved big time. And then, of course, if we look at the front month vol term structure, you can see here on this weekly chart, but let me put it back on the daily again. You're going to see the term structure is slightly in the red. So near term, it's not that concern. And if we look at the back month, that would be the July-August vol skew. We're a little bit more in the red here. That means there is a backwardation in the volatility skew. So there are opportunities here in the options market to play these things. Members, we'll go through some of these again this Sunday, and then it's also covered in our option masters as well. But you got to understand how these skews work, because if you don't understand volatility in the skews and whether you're buying an expensive or a cheap option, you're really setting yourself up to just not do very well in the option market. And of course, we cover all that in our option masters, and as a member, you get access to that. If we look at the Treasury market, you can see here it was down a full handle, right? And coming down here really drove interest rates up a little bit. Okay, so they came up just a little bit on the day, but you can see here on most of the week, the interest rates went down, and safety kind of came back into the bond market. All right, that would be expected, basically. Of course, if we look at currencies, I think longer term, as I've been saying, the dollar is going to be weaker. You can see the shift, the move lower in the dollar. It bounced off the opening price of the dollar for 2020. But I think longer term, the dollar is going to go lower. Okay. And there are other things in the currency market we're watching for our members. I'll go through some of that stuff this Sunday evening for our weekly market watch. Of course, if we look at metals, let's look at gold. Okay. Gold is tricky. As I said many times, gold is it's a day swing trade, 1 or 2 days at best right now. I mean, look at this, up, down, up, down, up, down, up, down. It's kind of like a porpoising, like a porpoise through the ocean. We go up, once you get up here, it goes down, and vice versa. I don't think we're going to get a breakout until we get a break in the markets. If we have another shutdown in the economy, you're going to see bonds go up, interest rates go down further, and you're going to see gold break out of the 1788. Otherwise, short term, I think gold is going to be mostly neutral to slightly down. Okay. Same thing with silver. And of course, if we look at copper, this was one that we played, I have to admit, brilliantly for our members, calling this thing out. As I said before, I had our members getting long here in copper, and there's other ways to trade copper if you don't want to trade copper futures, and it's just been a great run. Okay. And I think it's still got more to go. A little bit of a consolidation here, but I think it's got a little bit more to go. Energy and oil, we also had a great play in oil. You can see here off this zero rate for oil, it's just moved steadily higher. And we played oil. There's a certain way to play oil. If you play it any other way, you're going to dramatically increase your risk. For our members, I've gone through the best ways to trade the oil markets. These are low-hanging fruit trades, guys, from the metals market, especially copper to oil. And then, of course, if we look at nat gas, you're going to see nat gas here. We've been in this long range, okay? I think it can go a little bit lower, but it's just basically, I'd like to see it get lower, and then we'll slap on another one of our trades again, okay? Now, there's not a lot going on. There is some things going on in the ag markets and some of these other markets here, but members, I'll kind of go through some of that with you this weekend, as well as certain key stocks that we're looking at that I think can be a really interesting play here as we start to set up for new potential buys here. But keep in mind, I do believe the markets have a little bit more ways to go to the downside. I think we're going to get that over the next couple of weeks. So we'll see as we go through June into July, some of that. If the markets move up a little bit Monday and Tuesday, I'm not going to be sucked into that unless, as I showed you on that 30-minute chart, we take out those key levels. Members, I'll go into more detail for you this Sunday evening in our weekly market watch. Everybody else, have a really great weekend. If you're not in our group, love to see you come in and join us. Otherwise, enjoy the weekend. Members, I'll see you this Sunday evening. Take care, folks. Ciao now.